All right, good afternoon. Welcome to today's live recap. So heading into the open, our intermediate term bias was still bearish and our short term bias was still neutral, but with the understanding that holding below the 53.9075 to 54.0575 pre-market resistance, which we were also using as the micro bull bear zone, would be a sign of continued weakness from the overnight session. And holding below pre-market resistance and the micro bull bear could result in a move back down into the pre-market as well as initial support at 53.40 to 50, and that was the intraday bias changing zone. So a break and hold below that area on signs of initiative selling would serve as an intraday bearish indication, and that could then result in downside range expansion into 53, 15.5 to 26, as well as the next bias confirming zone at 52, 51.5 to 65.5, where technically buyers could still be active on first test. And the lower the market pushed, the higher the odds of buyers stepping back in. On the upside, a breakout above the micro bull bear zone would be an indication of intraday strength. It would tell us that the control could now be shifting from the sell side back to the buy side. But in order for the intraday bias to then turn bullish, ES would need to take out initial resistance. So a break above the micro bull bear alone would not be enough. We would also need to take out initial resistance. And in that situation, the intraday bias would turn bullish. The low of day would likely be in, and there would be potential for upside range expansion into the resistance areas above. And the next notable area of resistance was up at 54.7775 to 97.75, and we would need to see signs of initiative buying in order to take that area out. Lastly, if the market continued to run on below average volume, then the range potential could be impacted by that. So that being said, let's jump into the chart and see how it played out. Today was actually a very informative and educational day, and I think that it's actually packed with several important lessons. So this morning we see a move down into the initial support zone. ES is, at least on the smaller time frame, a bit exhausted, heading into initial support. And if we look at the market internals, we can see that there is a bit of a bullish divergence on the advanced decline line. And even though the NYC tick is holding below zero, it is not printing any big or notable downside values, which means that even though, yes, we have some level of sustained downside momentum, it is not any major downside momentum. And given that the market moved from 53.8875 down into initial support in a relative straight line, the market's exhausted. And at the very minimum, there is probably going to be a reaction at initial support. Now, with that in mind, it would be valid to attempt a long at initial support, but the key is to still be more defensive on the long side, because from a market structure perspective, holding below the micro bull bear tells us that the market is in a weakened state and that the sell side is more dominant. So taking a long at initial support is still technically counter to the in-play bias. So you want to structure the trade in a way where you can get your scale target either at or ideally ahead of the broken pre-market support. We also had the opening range low at 53.65.5. So you want to structure your trade in a way that allows you to get your scale target fairly easily, and that then means that you can reduce your risk fairly quickly. And then you can decide if you still want to hold on to this trade or move on to the next viable high expectancy opportunity. So let's take a look at how we could structure that trade idea in Vulcan Trader. So you can see that by default, Vulcan is setting up the targets to be 53.75, which is the broken pre-market support, Our scale target is ahead of the broken support at 64, so that checks out. And then even our final target is relatively conservative in that we're only looking for a move back up into the pre-market resistance or the micro bull bear. So we're not looking for a lot. We're just looking for a possibility of an intraday reaction that perhaps could lead to a test of the micro bull bear. But even if it doesn't, if you're in from 48, let's say the market only goes to 75, well, from 48, that could still give you 2.5R. And that's just a bounce back into the prior broken support, which may now begin acting as resistance. So 48 is a fairly good price to take that trade. And if you want to be really conservative, then the entry would be 46.5, and then you could get 3R into just 75. And if the market goes higher, then you can get perhaps a little bit more, and now you get 3.75. So the challenge is that the more conservative your price is, the less likely you are to get filled. Now, because the trade is technically counter to the in-play bias, it would be fine to have the mindset that you're okay with missing it, and you either get your ideal price or you skip the trade. That's perfectly okay in this particular situation. But 48 would be a very viable and acceptable entry price where you still have 3R potential, maybe more. But again, if it only gets to 75 and you're in from 48, you're still getting a healthy profit of 2.5R. Your scale target is very easy to hit at 53, 57. So all of that checks out. So that is the first idea following the open. Because off the open, the market did not push up into the micro bull bear, so the short side play didn't really present itself. If you were able to get short ahead of the open, that's a different story. You'll notice that today's micro bull bear kind of overlaps with yesterday's initial support, which was a bias changing zone. So as the session plays out, we can see that there is a conflict here between the market internals and the market structure. And usually the market structure wins out. Typically the market structure wins out. But of course, nothing happens every single time. No rule, no idea, no principle works all the time. Trading is a game of probabilities. So all we can say with a healthy level of confidence is that if there is a conflict between market structure and market internals, you are still better off giving more weight to the market structure rather than the internals. You need to take a appropriate weight. You need to assign an appropriate weight to the internals, and the market structure always gets more weight. Now, that being said, we can use this positive divergence on the advanced decline and the lack of downside momentum as a reason to structure a defensive long at initial support and then get that quick scale out, reduce our risk by 50%, and once the first hour range is in, then we can even move our stop to just below the first hour low. So at that point, we are at zero risk. And that would be perfectly valid. We would be taking the market internals into account while still being mindful of the bearish market structure. Because remember, we're not looking for a major breakout. We're not looking for a move into even the previous close or anything like that. We are literally just looking for a bounce back up into either the micro bull bear or at least the 75 area. And if you exited at the 75 to 83 broken support, that would be perfectly fine too. That would still be a very healthy profit of 2.5 to 3R. Now, when the market breaks above the first hour high, you can see that the breakout is happening on broad market strength and some decent upside momentum. We end up actually pushing higher on a plus 1100 tick reading, which is very significant momentum. But the interesting thing to note is that despite that momentum, there was zero follow-through in price, and this actually turned into a false and failed breakout pattern. So we can see that the launching point of this upside move is roughly at 5370.75 to 76. So this area, 70.75 to 76, marks the launching point of this upside breakout. And in order for a breakout to remain in play, the market needs to hold the breakout bar. So that means that the market needs to hold above 70.75 to 76. And when that doesn't happen, this turns into effectively a false and failed breakout pattern. And the fact that the micro bull bear zone held, and that is where this failure took place, is also very telling. So once the market shows us the failed and false breakout pattern, now we have to discount and ignore the advanced decline. We can't continue to put stock in the advanced decline, expecting the market to eventually go higher. There was a battle between the internals and the market structure, and the market structure won. That is the takeaway once the market fails. Now, could you technically short the micro bull bear zone and fade that momentum? Sure, it's a viable idea, but it's not necessarily a high probability idea. It's more of a 50-50 type play. Because in some situations, that plus 1100 tick reading will result in upside follow-through. And you might end up going up into initial resistance before you get a respectable sell response. So if you want to short the 53.9075 to 54.0575 area, you need to structure it in a way where your scale target is at or ahead of the first hour high. Because now that first hour high is potential support if the breakout is going to succeed. And you want your scale to get hit even if your setup fails. So if the breakout succeeds, then the zone fade fails. So you need to structure the trade in a way that you can still get your scale ahead of 88.75. So that means we would need our entry to be at the very minimum at 53.98 so that we can get our scale at 89.25. And of course, the higher the entry is, the better. And the better the risk reward and easier the scale. That goes without saying. And again, in this case, you can have the mindset that worst case scenario, you miss out on the trade. You need to structure this defensively if you are even going to take it. And you don't have to. But if you're going to fade the micro bull bear, then you want to structure the trade to give yourself the most room to let this trade work out. And you want to make it more difficult for the market to hit your stop, and you want to make it easier for the market to hit your scale target. So what we can do is simply move our, if we are willing to take 5400, we can just move our stop further beyond the zone where we can still get a healthy reward to risk and still get that relatively easy scale target ahead of 88.75. So in this case, if you moved your stop up to 0875, so now you are 3 points beyond the zone, or into 0975, now you're 4 points beyond the zone. That would just give the trade a better shot at working out, and it would ensure that you don't get stopped out prematurely via a little poke above the zone. And again, this is not a must-take trade. At the very minimum, I would take profit at the micro bull bear if you are still holding a long position from the morning. So if you're still long from the morning, I think it's a good idea to get out anywhere within the micro bull bear zone. That would be a balanced approach where you gave the internals some weight and use that as a reason to go long in the morning, but you still did it in a defensive way. And that means you gave the micro bull bear zone its due weight, and then you exited at the micro bull bear, which again means that yes, you took the internals into account, but you also gave appropriate weight and importance to market structure and the zones are based on market structure. So at the very minimum, you want to exit in the micro bull bear. But remember, you're probably not the only ones who are exiting there. Other people are going to exit there too. And that can create at least a reaction at the zone. So if you can structure the trade in a defensive way where you can get a quick scale out, then at least it puts you in a situation where perhaps you can actually see that trade through because you've reduced your risk. You can then tighten your stop and then see what happens. But again, it's not a must-take trade. But once the market takes out 5370.75 to 76, well, now this is a failed breakout. We can take that observation, but it doesn't mean that we can immediately act on that observation. Here's what I mean. Just because you have that observation that this is now turned into a failed breakout doesn't mean that you will instantly have a trade setup ready to go for it, because that is a hypothesis that the breakout has failed, the micro bull bear zone is held, market structure has won against the internals, and that means that whatever range potential is now left could play out to the downside. That is a hypothesis. But an execution requires more than a hypothesis. Hypothesis is the starting point, but then you need to structure the trade. Okay, well, what would the market need to do to prove my hypothesis wrong or to invalidate my hypothesis? Well, in this case, the market would have to make a new high on the day. In order to prove this hypothesis as an invalid idea, so to invalidate the hypothesis, the market would have to make a new high on the day. Because if ES went back up into the micro bull bear and then made a double top there and then failed, that would still be okay, right? The hypothesis would still be in play. So the invalidation point now is going to be above 54.01. And you can't execute that. See, you can have the market read, but you can't execute the market read because the stop would be too far away. The risk reward would not be justified. But what you can do with that market read is get ready to trade the breakdown. If the breakdown happens, that's a different setup, right? That's not a zone fade. In that situation, the stop does not have to be at 54.01 quarter. If the breakdown happens below the first hour low and below initial support, that is a different trade setup altogether. And for that trade setup, you don't need a stop at the high of day. Now you just need to use a volatility stop. And you can short the break below the first hour low or below the overnight low. Looking for then downward range expansion into the next bias confirming zone. So that means if we take out initial support, we are probably going to go down into 52, 51.5 to 65.5. That also coincides with the 100% range extension of the overnight range. And if the market breaks below this area, it would mark a intraday balance breakdown below the first hour range and a balance breakdown below the entire overnight range. And a 100% extension of the first hour range can take you to 53.03 quarter, and a 100% extension of the overnight range, which is the larger balance in play, can take you to 52.55, or in other words, into the 52, 51.5 to 65.5 area. So what we can do is, by making that observation and that hypothesis, we can set up an intraday balance breakdown setup, looking for a move down into 52.65.5. Our entry can be as low as 39.50. Our stop, in this case, is 51, which is fine. It's a volatility-based stop. You can see that the volatility stop right now is 11.5 points. And the way the intraday balance breakdown setup works is that it uses the volatility stop. And the idea or principle behind that is that the intraday balance breakdown setup is a purely momentum-based setup. And if the momentum is truly in your favor, the market should not retrace 11.5 points from the breakdown area. So that's one way that you can enter the trade. The other way is if you are waiting to time it, is that you can enter on the first micro pullback within 1 or 2 minutes of the break. So in that case, you might get a better entry. The first hour low is 46. Maybe you can get in at 43, on that little micro pullback. So here is what I mean. Here is the breakdown bar. Here is the micro pullback. So again, it typically happens within the first 1 or 2 minutes. And on that micro pullback, ES bounces up into 45 quarter, which means that you could have easily shorted 43, 44, and because we are using a volatility stop, the stop just ends up getting pushed further out, the better the price is that we get in at. So if we get in at 45, then our stop can be 56.5. Now, if we get in at 43, it's still a respectable stop. Again, it's based on the stop size. And even if we get in somewhere near the bottom of the broken initial support, we can still, you can see, get 5R into 52.65.5. And that then serves as our high probability and our final target. If we chose to exit part of our position, or even the bigger part of our position, at 53.15.5, right, the support that was in between, you're still getting over 3R. So no matter how you look at it, this is a high reward to risk setup. And you can take it either on the break below the first hour low. So that means your entry could legitimately be 45.5. That's the ideal way to typically execute these trades. Or if you want to be a little more sure of the setup, you can wait for the break below initial support. And because we had this positive divergence and bullish disconnect and everything going on earlier in the day, you also have an aspect of trapped buyers in play here. Because remember, we are in a bearish environment right now. The intermediate time frame bias is bearish. Technically, even the intraday bias below the micro bull bear zone suggests that the sellers are in control. So you have a situation where the smaller time frame, the intraday time frame, is going against the larger time frame, which is bearish. And most of the times, the larger time frame wins out. And that's what we see happening today too. So when we get that balance breakdown below the first hour low and initial support, it's an ideal balance breakdown because it's in alignment with the intermediate time frame bias. It's in alignment with even the intraday bias. And on top of that, because you had the bullish divergence on the internals earlier in the day, which probably sucked a lot of people in on the long side, you also have trapped traders and trapped buyers. And that can lead to an even more extended move on the downside. So that's what makes this such an ideal intraday balance breakdown play. You have so many different factors coming together to support that trade setup. You have a confluence of reasons to take that trade setup. And again, you can either take it on the break, or once the market takes out the support zone, then on the first little pullback, get in, put your stop 11, 12 points away. It's a volatility-based stop. And then look for range expansion into the support areas below. And ideally, you do want to hold on to that trade for 65.5. Because remember, if you're scaling out at 53.28, or in this case 30.5, you've already reduced your risk by 50% anyway. So that's the other nice part about this trade, is that your scale target is ahead of even the next support zone. So even if this ends up being a failed breakdown somehow, which it didn't look like it would be, but let's say that you thought, hey, maybe it's going to fail, you would still get your scale out before it failed. So that's what makes this such a textbook and ideal opportunity. There are many breakouts and breakdowns that don't have the ideal conditions to support getting aggressively involved, but this one really did. So this is an ideal intraday balance breakdown play. From there you can see we just continue and we sell off right through the next zone. It was not a bias changing zone or a bias confirming zone anyway, but we slice right through it. And then when we come back, that broken support acts as resistance. And that brings us to yet another viable trade setup. And that is the pullback continuation. So this is the launching point of the downside break. And you can see that right here, the market pushes up into the 38% retracement, where we also have confluence of the broken support, which is now acting as resistance. We are selling off on big downside momentum. The pullback continuation setup is a momentum-based setup. It's mainly a continuation setup. The pullback is simply a mechanism of allowing us to get on board at a good enough price, but it's primarily a continuation play. And in this case, because we are selling off on minus 1100 tick readings, minus 1200 over here, it tells us that there is big momentum in our favor. And that is exactly when the pullback continuation setup works extremely well. And in this case, even more so because we also have confluence of broken support acting as resistance. So we can take this trade idea as well and look for a move down into the 55 to 65 half area. That's going to be our final and high probability target in this case. And lastly, we arrive at the bias confirming zone, which I've received a couple of emails asking about how we could have traded the bias confirming zone because some traders went long at the back of that zone. So now let's think about what we could do with that zone down here. It's a bias confirming zone. Bias confirming zones, by their very definition and nature, are usually high probability areas for taking a zone fade. Now, that being said, this zone is being tested in the last hour, which is by far the riskiest time to take a zone fade. So if we are going to take a zone fade, we should set up the trade in a defensive way. So if buyers step in here, where could the market go? Well, we could bounce back up into the swing low at 87.25, and we could also bounce back up into the broken support, which can now act as resistance. So on the upside, 87 and 53.15 should be our targets. So let's go ahead and set up the trade with those targets in mind. So if we are going long here and we're looking for 87 as our high probability and 15.5 or even 15 as our final, and we want to get in at the back of the zone, and you can see that if we enter at the back of the zone, we get 6.7R out of that trade. Just like I showed you on the upside, if you want to play defense, don't just put your stop 1 point beyond the zone. Defensive entry means that you have the freedom of using even a more defensive stop. So instead of putting the stop just 1 point or 1.5 point beyond the zone, why not put it 3 or 4 points beyond the zone? Because you'll still have a healthy risk reward. So why not put the stop at 47.5, 4 points below the zone? And if you're getting in at 55, which is the 100% range extension of the overnight range, and the entries at the lower quadrant of that zone, then you still have 4.5R potential. If you get an even better price, you might even get 5R. Now, of course, the lower you go on this, the lower the odds that you'll get filled. But the mindset for this fade should be that either I get my ideal entry price or I will skip the trade. You can't have FOMO on a counter trend trade, especially when the intermediate time frame is also bearish and the intraday has now been proven bearish. And remember, when the short term is neutral, the intraday takes its place. So there's no rush, there's no fear of missing out, or there shouldn't be. So be patient, get in towards the back of the zone. And that gives you 6R potential with your stop 4 points beyond the zone. Now, if you want to take this one step further, what you could do, because the zone fade is occurring in the last hour, which is the riskiest time to take a zone fade, you could just risk half an R from the get-go. So instead of risking 1R, trying to make 6, you could risk half an R and make 3, which is still a very healthy profit, especially considering that your worst case scenario is that you lose half an R. So how you do this is going to depend on your risk profile. It's not a one-size-fits-all situation. This is where you need to bring your own personality into it. As long as you are following the guidelines, the rules of the methodology, you can come out ahead. But within the set of rules and guidelines, there is room for creativity and infusing your own personality. And that's what you can do with things like this. Instead of risking 1R and making 6, which of course would be a fantastic trade, you could risk half an R and make 3. Like, that's still 6 times your risk, right? It's just that your risk happens to be only half an R. So that is a viable option too in situations where maybe you're breaking one of the rules, but you feel like, hey, this is an exception to the rule because the market's quite exhausted, it's hitting a bias confirming zone, the entry's at the back of the zone. If it works out, there could be big reward potential, and given that we're still running on below average volume, there's probably going to be at least short covering that takes place there. So, it's a viable idea, but it needs to also fit your risk profile. And by moving the stop a bit further out and still having 3 or 6R potential in that trade, you just set yourself up so that the likelihood of you losing money on that setup is as low as possible. And that really is the best that anyone can do. There's no way to guarantee a win in the market, but this gets you as close as possible. So that's what you can do at the support zone below. And remember, as soon as you get your scale target, which was at 59 in that case, if you're getting at 53.25, your scale will be 59. If you're getting in at 55, your scale would be 62.5, right? So you would get filled on your scale somewhere over here. So as the market comes down, your fill would be here, and your scale would be very quick within about maybe 2 to 4 minutes. And then you can wait for the high probability. And then if you want to wait for the final, again, that's a part of trade management. But no matter how you look at it, this trade idea has anywhere from 3 to upwards of 7, 8R potential. So that is how today ended up playing out. Again, I think it was a very instructive day. I would bookmark this recap and review it again at a later time because it really highlights so many different principles and trade setups all within a single session. You have a zone fade at initial support. That's a viable idea. You have a zone fade at micro bull bear. That's a viable idea. Then you have the intraday balance breakdown setup, very ideal. And then you have the pullback continuation targeting the final move into the bias confirming zone. You have the idea of market internals versus market structure. All of that is jam-packed into this one single session. And that doesn't happen often. So I think this particular trade setup is something you should bookmark and revisit from time to time. All right, guys, that is a wrap on today. Now, as we head into the upcoming overnight session, on the upside, the broken support zones can now act as resistance. And in order for the bias to now shift from the sell side back to the buy side, we would need to see a break back above the 53.65 half to roughly 70 half area, or 65 quarter to 70 quarter. Like this zone would need to be taken out because right now the larger relevant swing that is in play looks like this. So if we take out the broken initial support, that in itself would be a notable warning sign for sellers. If the market is truly weak, then we want to see ES holding below the 53, 15.5 to 26 broken support. That coincides with the 50% retracement of this dominant swing. If you take out the broken initial support, that is a notable warning sign because you would be taking out the 61.8% retracement. And if you take out the breakdown bar, so if you take out 53, 65 quarter, 70 quarter, at that point, it's essentially a false and failed breakdown, and that can then open the door for a test of the micro bull bear in the initial or the pre-market resistance zone and even the resistance zones above. So the main question in the overnight is going to be whether sellers can now hold ES below the broken initial support as well as the broken support at 53, 15.5 to 26. And then in order for us to get that intraday bearish confirmation, we need to take out today's low. So if that happens, then the bearish confirmation kicks in, and that then opens the door for more downside range expansion. But if we hold today's low and the buy is confirming zone, then we may just balance overnight. And of course, that means that there is still the potential for a break back above into the broken initial support. So that is the view and perspective as we head into overnight. Aside from that, I hope you all traded well. And as always, we'll be back at it bright and early tomorrow morning. Take care and enjoy the rest of your day.